Hey everybody, welcome back to the channel. So today I wanted to talk about this concept of revenue. I know revenue is very important. Of course, if you own a business, you want to see the revenue, meaning the top line going up. But is it the be all and end all? And that's the focus of today's video. So I wanted to focus on this article. Basically, it talks about what drives the share price. And there are two main things that drive a share price over time. Right, we know the market is a voting machine in the short run, and in the long run it's a weighing machine. So what exactly drives the share price? Well, what one thing that drives the share price is the earnings, of course, right? And then the cash flow, and then of course the dividends. Another thing that drives the share price will be the multiples that investors are willing to pay for that company. For example, if a company is today worth at a PE of about 10, and the market sees that this is a more higher quality company is willing to pay a PE of 20, that share price could just double, right? So revenue growth is usually good. I mean, we definitely want to see our earnings and our cash flow grow, but don't hate the businesses that have slow revenue growth. And I want to do a case study on a few companies: Boeing, SPGI, which is S&P Global, and McDonald's. Right, these are the three companies that we'll look at. So let's look at the price first of all. The nice price increases that all these companies have had. You can see that Boeing has exploded basically over the last 10 years. S&P Global also has done very well, and even McDonald's has done very well, right? But then let's look at the revenue of these companies. So in terms of revenue, nothing as spectacular. Boeing has increased 59, it's almost 60%. Decent, but nothing very spectacular. McDonald's has even decreased, and McDonald's revenue is decreasing because it's becoming more of a franchisor. So it's not running less of its own restaurants and leaving the running and operations of the restaurants to franchisees. So it doesn't collect as much revenue basically. And then we have S&P Global, which also has not had much increase in revenue. I think Boeing is clear what they do. They make planes, right? And McDonald's, we know what they do as well. S&P Global has three main businesses. It's in the index licensing businesses. Basically, the S&P 500 is a index created by S&P Global. And he also has a data analytics division where he sells data in terms of investments. And he also has the very important credit rating division where it issues credit ratings basically to companies who want to get loans. So having said that, the revenue has been nothing spectacular for these companies. But as we saw earlier, the share price has really increased dramatically for this company. So what has driven that share price? Basically, I think the answer lies in the operating margin. And then here we can see how the operating margin for all these three companies have also increased. Again, Boeing has really risen very dramatically over the last 10 years in terms of operating margin. And so has S&P Global and McDonald's as well. If you want to look at the operating margin in terms of a 3-year median to get a more smoother graph, you can also still see that a lot of these companies have had their operating margin increase. So S&P Global has increased over 85% over the last 10 years. Boeing has increased 48%, and McDonald's has increased 36%. So the operating margin has definitely been marching upwards, even if the revenue has not matched that kind of growth. If you want to look at the real percentage numbers for the operating margin, you can look at that here. So we can look at this again and see that McDonald's had an operating margin of about 29.20%, and then it's increased all the way to 41%. And we can see S&P Global started with about 19%, has increased all the way to 44%. And for Boeing, we can see it was about 3% here, and increased all the way to 11%. So just a basic introduction on operating margin. What is operating margin? Basically, we earn $1 in revenue, and after you have deducted all your operating costs in running the business, what's left over is your operating profit, and it can be expressed as a percentage when you divide it by revenue, and then you get your operating margin. So for example, 11% here for Boeing means out of $1 in revenue, 11.15% is operating profit. If you look at the EBITDA margin, EBITDA is a good approximation of cash flow, and that too has also been marching upwards. You can see here McDonald's started with 35%, and then it's gone up to about 49%. You can see S&P Global started with 28%, it's gone up to about 47%. And also for Boeing, started with about 5% here, and it's gone up to about 13%. So operating margin and EBITDA margin have both marched upwards. So why have these companies been able to increase their operating margin and EBITDA margin? Well, it's because of their strong moats. There are only two airplane makers in the world, or two major airplane makers, Boeing and Airbus. So there isn't much competition. So they can price their airplanes at a higher price every year, so they can increase their operating margin and their EBITDA margin. The same thing goes with S&P Global. There are only about three major credit rating agencies: S&P Global, Moody's, and Fitch. And S&P Global also has this indexing business that I mentioned, and there are also only about three players in that: S&P Global, MSCI, and I think the London Stock Exchange. And we know about McDonald's. McDonald's is a powerhouse F&B company, and with the greater number of restaurants it has, is able to extract greater prices from its suppliers, and is able to have greater profits. So the moat is very important, right? This gives them purchasing power. In some cases, they can vertically integrate their operations, like Boeing has bought over some of its suppliers, so that lowers down costs as well. So focus on the moat. Don't focus so much on the revenue growth or lack of growth, and keep an eye out for the operating margin, and especially if there's expansion. And if there's decrease in the operating margin, that may be a worrying sign as well. So I hope you learned a little about why operating margin is very important, why revenue growth shouldn't be that worrying, and why the moat of a company is very important when choosing your stocks. Have a great day, and thanks for watching.